That's the nice thing about that structure. It's so simple that it's easy to do some back of the envelope math, just like that. That is truly no more complex than that. Sometimes I'll have to go through like a 15-minute phone call with an investor. It almost seems too good to be true, or too simple to be true, and they're like, okay, so what about if this happens? What about if this happens? No, it's truly just as simple as you just laid out there, Brett.
What's the number two secret to an investor-focused passive investment?
So we have a radically different business model, not just in how we buy these assets and target an indefinite hold period, but also the way we structure our private equity fund. So there's no asset level fees whatsoever. So there's no acquisition fee, capital event fee, disposition fee, loan recourse fee, marketing promote fee, and we don't get any of the profit from the venture until our investors have gotten a full return of capital. And then it's a 50-50 split after that. And if you kind of pencil all that into a calculator, you'll see that in almost any scenario, a typical limited partner, a typical passive investor, they'll come out ahead with the way we structure things versus a traditional real estate syndication structure or private equity fund structure, where the limited partner might appear to be getting a larger share of the equity, but when you figure out just how heavy that fee load is, it can be very substantial in most cases. There's almost no scenario where a limited partner is going to come out ahead with that traditional structure. And then it keeps incentives just laser aligned, because we only make money when our passive partners make money, and only after they make money. So in any situation you encounter, we're constantly asking ourselves, okay, how can we just get the best return? And there's never this disalignment of incentives. There's lots of things to think about. It. You have kind of a sophisticated audience here, so think about a typical fee load on a project that's going extremely well. That general partner has this huge incentive to sell that project really quickly to kind of boost their fees that they can collect. They get a small portion of the equity return and a huge portion of their income from the fees. So if the deal's going amazing, they have this strange incentive to kind of churn that deal as quickly as they can and say, oh, we got this amazing IRR or what have you. When the thing for the LP in that situation would probably be to hang on to that asset, but the LP, they get compensated on an equity basis. So there's a huge disalignment there. And then let's think about if the deal doesn't go so well, which, in the years 2023, 2024, that's a not so hypothetical situation to contemplate. Well, let's say there's a preferred rate of return that's supposedly something that looks out for the limited partner's interests. But again, it just creates this disalignment of incentives. What if that deal, isn't hitting that preferred return? It accrues year after year. Let's say a few years go by and all of a sudden the GPs owe like a 20-25% preferred rate of return to their limited partners. Well, again, there's this huge disalignment of incentives now, because the GPs, they get basically no compensation whatsoever for the deal returning, having a return on investment. In fact, the only thing they get income from is the fees. And indeed, they can often make fee income from selling the asset, even if the asset is sold at a loss. So there's this huge disalignment of incentives that can happen on both sides of that spectrum with a traditional syndication structure. There's good reasons why those structures are the way they are, and they theoretically do incentivize good outcomes, but those incentives can become terribly disaligned in many very common situations, especially with the state of the market today. So we have an incredibly simple structure. We jokingly call it a lemonade stand model. Very easy to understand, no fees. We don't get any profit until our investors have gotten all their money back, and we find it keeps all of our incentives laser aligned and really puts the needs of our passive investors first.
Got it. Okay. Yeah. So it sounds like no fees of really any kind, and it's just a 50-50 split. So if like you're buying a $10 million asset, and let's just say just keep it simple, 5 million, put 50% debt in it onto the deal. Investors come with the full 5 million. You guys manage, buy, operate all of the things and no fees whatsoever. And then, the property increases to, let's say, 15 million over 5 years, right? So it's about a 33% increase. And that scenario, you probably do a cash out refi at that point. But let's just say you did a cash out refi at that point of 10 million in this scenario. Let's say that's the number. And that they get the original $5 million back, and then they would split that other 5 million of equity that's there. So 2.5 million would go to you guys, Black Swan team. And then the other 2.5 million go to the investors. Is that a fair summary, Nick?
You nailed it. That's the nice thing about that structure. It's so simple That's easy to do, some back of the envelope math, just like that. That is truly no more complex than that. Sometimes I'll have to go through like a 15-minute phone call with an investor. It almost seems too good to be true, or too simple to be true, and they're like, okay, so what about if this happens? What about if this happens? No, it's truly just as simple as you just laid out there, Brett.
Okay, cool. Yeah, that makes some sense there. And then you mentioned on the other side, yeah, it could be like 80-20 or 70-30 with a pref return. And I think I think I heard that right as well. It's like, well, if the pref is building up, let's say it's an 8% pref or 6% pref, and in a couple of years the deal's not going so well, the sponsors essentially in debt to the pref, which then they look at it and they go, well, I'm not making any money, but I'm doing all the work. And what you're saying, that in that scenario, the deal kind of crumbles. Is that what you were saying there, Nick?
That's exactly right. Limited partners often think of the pref as this like protection mechanism that kind of puts their interests ahead of the general partners. But if you really think about that for a second, like what if that scenario truly comes to pass where that pref is owed? You've taken away all incentive for that general partner to work hard to deliver return on the deal. So I see a preferred rate of return as often being kind of a marketing thing that gives limited partners a false sense of security, and ultimately just disaligns incentives if it truly comes into play.